Securities offered through Cetera Advisor Networks, LLC, member FINRA SIPC. Investment advisory services offered through CWM, LLC, an SEC-registered investment advisor. Cetera Advisor Networks, LLC is under separate ownership from any other named entity. Carson Partners, a division of CWM, LLC, is a nationwide partnership of advisors. This is The Way to Wealth, with host Scott Ford, a jiu-jitsu fighting, woodworking, beekeeping entrepreneur who is also the managing director, partner, and wealth advisor of Carson Wealth. Financial freedom is the goal, and clarity and simplicity is how we'll get there. Let's get to it. This is Way to Wealth.
Hello, and welcome back to the Way to Wealth podcast. I'm Scott Ford, your host. And look, the Way to Wealth is all about making money simple. That's what we strive for, giving you the ability to live life and live it fully now. So that's what we're about. Excited today, excited to introduce and have a chat with my friend and colleague, Jeff Socha from Texas, and talk about taxes, what it is, what it isn't, some misconceptions. And so we're going to jump right in. But with that, welcome to the Way to Wealth podcast, Jeff Socha.
Hey, Scott. Thanks for having me.
Yeah, man. Thanks for being here. So all good. And I think we talked about, I don't know if that was you or me in the background on the computer, but it's probably me. So I'll just go with it. It's all good. So one of the things that, we talk about in the Way to Wealth podcast, Jeff, is just the foundation. So, the way, the number 2 is the team, and then W in the wealth is the what is the foundation. And there's 6 bricks in that foundation. And one of them is taxes, and we call it tax delta or tax reduction strategy. The point is taxes are typically everyone's biggest expense. And that surprises a lot of people, but from experience, that's typically the case. And we don't always start in that order where it's tax delta, tax strategy. When I illustrate it, I say tax reduction strategy, then estate, asset, et cetera. But definitely it's a key component and ingredient. So before we jump into that, that's certainly the goal of today's chat. I know you, but the audience doesn't, so would love to hear a little bit of your backstory, just how you got into the business and just kind of what landed us here today.
Sure. God bless the broken road, I guess, for getting us all where we are today. But I think my family origin actually plays a bigger piece of it than I maybe used to give it credit for. But I grew up in a family-owned business, and it was a construction company that my grandfather started back in 1950. So it's third-generation business, and there's a lot of entrepreneurs like that, where they're not household names. They've got a good business going, and there's a lot of financial decisions that they need help with. And I remember taxes, I think, being one of the big complaints that I would overhear. Went to Texas A&M for undergrad and got a degree in engineering and minored in finance. I really approach financial work like engineering. It's problem solving. It's identifying all the variables and resources and what you're trying to accomplish in engineering solutions. And then went to business school at Harvard, and then spent 5 years doing some part-time lobbying for a couple of different PACs on tax legislation. And that was really during the time when I was, researching, investigating, really more of this curiosity that I think I would always hear in my home growing up, hey, the really rich don't pay all their tax. The really wealthy people don't pay all their tax. There's got to be a way. And I don't know if it was just some subconscious thing to, solve that family problem or what, but kind of embarked on a mission to see, is that real? Like, is it possible? And slowly but surely kind of uncovering one thing and then another thing to figure out, wow, there's some things you can string together to create some tax efficiency.
Interesting.
I think it's wild, all the stuff from our childhood that affects us as adults. I mean, I hired my first financial advisor when I was 15. I've been saving all my money from working in the construction company. And at 15, I think I had saved up like $20,000. It's like, this is a ton of money. Yeah. It's like, you need an advisor, And so I had to ask my dad, and do you have an advisor? Can you, I'm reading my dad's like money magazines or whatever. And I'm like, can you get your advisor to come over to the house? And so, and so that guy came over and met with me. I don't know, we shoved it in some mutual funds in the 90s that everything was going straight up. So
Nice.
made it seem really easy, but yeah, that was an interesting experience.
Yeah, for sure. And it's funny you say that, Jeff, because I was actually going to ask, like, what's your earliest memory of money? Is that it? Is that your earliest memory of money in childhood?
No, I mean, I think my earliest memory of money, I did not grow up in a family that was, if you need money, you go and you ask dad for or mom for $20 to go to the movies or whatever. That was not how our family worked. So from the earliest ages, all I can remember is that if you wanted money, you had to work. And so I think one of the earliest memories, I don't know, I must have been like 5 years old or something. And I remember I got paid $5 a day if I would go to work with my dad. I don't know what I did. Take the trash out of the shop, sweep. Like I don't know. I don't remember, sort out little parts and pieces of, material. I don't know, whatever a 5-year-old could do. And I remember just thinking, like, okay, I get it. Like I go spend a day at the shop doing stuff, and that's how I get $5. And then, and if I need $20, well, I can't spend the $5. I have to, go to work 4 days or whatever to get to the $20. But my parents, they really instilled a lot in me that I didn't understand, that it's not common, when you're a kid. Like, for example, half of whatever I got paid had to go into savings. It was untouchable. And 10% had to be given away. And so it instilled this philanthropic, generous, charitable nature from an early age. And it also instilled a savings. You don't spend, and our savings wasn't saving to spend, which is what I think a lot of people do today. It's not quite saving. So then, like, out of my leftover money that was left for spending, I could save my spending money up to have more to spend. But the savings, I don't know, there was no internet. I was like, a kid, they put in a savings at some bank. You don't even know how to get there. Like, it disappeared. Right.
Yeah.
So.
Yeah, that's so interesting. And I like to ask that question because in every area of our life, I mean, we're affected by our upbringing. I mean, there's patterns that get imprinted, and in working with people, you see that. And in money, there'll be things of conversations in areas that they're struggling with money, and sometimes you can trace it the whole way back. So just recognizing that, you can heal and or grow from that. And so that's why I like to ask these questions. So for me, as an example, a couple of things came to mind as you were sharing. So dad, specifically mom and dad, but really dad taught me how to work, meaning hard work. I can remember in 7th grade, I mentioned he was a minister, so I had a church, and they didn't have much money. So I did a lot of work there. In fact, an entire edition of the church in 7th grade, I roofed by myself in the summer. And so my reward for that is dad would come at the end of the day and bring a Pepsi. And I tell that story and looking back, and it's exactly what happened. People are like, really? Like, that's extreme. Yet I'm thankful because it really taught me to work. What it didn't is like the money piece. So my early childhood memory was we were at some church camp when I was real young. I had like $5 left and I had to get home. I told this story at an earlier podcast, but this is my earliest memory, or one of my earliest. And, they're trying to raise money. So I'm like, you know what? So I put it in, but I'm thinking I got to figure out how to get home. And literally within 10 minutes, someone came and gave me a $10 bill. And that left a mark on me that's like, oh, wow, like there's some sort of magic in this giving thing, right? And no matter who it's to or how, it's just being generous is a great money habit. And I learned that at a young age from that example. It left a mark.
I couldn't agree more. Like I genuinely believe that, like, you cannot master money. It doesn't matter what financial strategy we talk about. If you don't have the ability to give it away, you're not in control of your money. Your money's in control of you. I think that is the mark for saying, do I have mastery over my money?
Yeah.
And the ability to give it away is, I think, when you can master your money. I think that the story, like, I think of money like in a tight fist, right? So like, if I can't give it away, it's like, man, I've got cash bills, and they're sticking out of my fist, and it's not going to leave because I got this tight grip on it. But it's also really hard for money to get in there. But if I have this like open hand with money and I go, okay, well, hey, I'm going to give my $5 and I'm going to recognize there's people in more need than I am. I'm going to be generous and I'm going to like have awareness of the world around me. Well, that open hand can also receive money much easier.
Yes.
And so, I would say to anyone that's struggling, if you don't feel like you're mastering money, or money is like a topic or something that you're having trouble like getting control of, is that the ability to give it away, like literally start giving some money away. If you want to change your financial life, start giving some away.
Yeah, that sounds so crazy and so opposite of what you would think to be true, but I totally believe it, and I believe it because I've done it and it works and I've lived it. So yeah, spot on, man. So one of the things I want to talk about is, in the way to wealth, there's this tax delta, tax reduction plan, tax audit, whatever you want to call it. The point is, taxes are our biggest expense. If you really look at your cash flow, you're going to see that. So when you think about tax planning, what's that mean to you? Just overall tax planning. What does that mean to you?
Well, I think you just got to think about, what does planning mean? And I think most people are going through life, going through the motions, like letting life happen to them instead of making and creating their life and putting some intentionality into their life. So you can think about any area of planning. And so for me, like having that engineering undergrad, it's like, okay, I think, what is engineering? It's just problem solving. That's what it is. And you go, okay, what am I trying to accomplish? What are all the variables I have to account for? And what are the resources I have to work with? Okay. So in planning, it's problem solving. And so in financial planning, you might think of one of the variables as tax. And you might think of one of the goals as, I'm trying to create more cash flow, or I'm trying to save more money, or I need to pay for this thing, or I want to be more philanthropic. I want to give more money away, whatever. Right. And so you start thinking about that, and then you can break that down into like sub components, and you go, okay, so taxes are one of the big components. So what's our plan for taxes? Instead of just letting it happen to us and complaining about it, are we going to actually be proactive and try to do something about it? And I think if you look at most areas of your life, if you just react and let it happen to you, you're just kind of wishful thinking that it's going to work out. And some people get lucky and it just, more of it works out than the average. But I think if we look at our lives, whether it's health or finance or whatever, when you're proactive and you make a plan and you say, okay, I'm going to like invest forward looking, I'm going to increase my probability of success and better outcomes. Mm-hmm. And so tax planning is just saying, like what you said earlier, okay, what other area of your life are you spending 20, 30, 40, 50% of your income on? I mean, if you own a business, what other areas are you spending that level of your revenue on? Yeah. Maybe payroll, let's say. So like, do you not make a plan for people? Do you not make a plan for like how I'm going to hire people and pay people and manage people? And like, you put all this energy and effort into it, but then you've got an equally large expense that put no effort into.
Yeah.
Right? So I think tax planning is just identifying it and saying, I'm going to stop letting it just happen to me, and I'm going to be proactive and try to do something about it.
You're speaking to this a little bit, and maybe you'll add additional color to this, is just about what people or what most people get wrong regarding estate planning. And I'll say it another way, like what's conventional wisdom versus maybe another way to think about tax planning. And so I'll give you my take on that briefly. So my thought is people will say, what are the loopholes that are out there that I can take advantage of? And like, that's an example, in my opinion, of a misconception, because actually what it is it's just pages and pages. I don't know the total, you may, but it's ridiculous amount of pages in the tax code as far as the document of incentives. So they're writing this basically as a playbook of, here's ways that you would benefit tax-wise or not pay as much if you did X, Y, or Z. And I just think that's a misconception. And if nothing else, it's a better way, I think, and healthier way to look at it. So we're not looking for some, loophole or tricking anyone. There's none of that. It's just black and white. Here's the rule book. Let's understand the rule book and then do what they're telling us that we should do to benefit ourselves from it.
Yeah. I couldn't agree more. I used to do these presentations where one of the slides I would put up is I would ask this question: how many of you have ever looked at the tax code? Right. And most people haven't ever read one paragraph, much less a page or whatever. And so I would just put up a page of some tax code that I thought was really wonky. And I'd say, show me the gray. And the point is, it's just black letters on white paper.
Yeah.
So, and that's kind of being facetious a little bit, because the gray comes into how do you interpret it. And so then you get down to like theory and philosophy and all the strategy and all this stuff. But at the end of the day, our government has kind of a couple of incentives, right? They have jail. Like, if you do these things, we will lock you up. So we're like, okay,
that's called tax evasion, right?
I'm not going to do those things, right? And then they pretty much have the tax code is the other big incentive bucket, which is like, hey, if you invest and you're investing to help, grow our economy, and you're successful at it, we'll let you pay a lower tax than just on your earned income. So we're going to give you an incentive to invest. Or, hey, we understand retirement's a big deal. So if you'll dedicate some of your investments to retirement, we'll give you tax advantages, right? Or taking care of your family is important. So, we'll give you incentives on insurance. Or, so like they give you incentives, right? And I think the word loophole is really funny, because I don't really think there's such a thing as a loophole. I think what it is an inefficiency in the tax code. So what happens is you have the people writing the tax code who generally, like, let's just put on our like common sense logic hat. The government doesn't necessarily have the highest performing like job from a financial compensation. I don't know that anyone really goes to work at the IRS to get wealthy, right? Like, and so a lot of your like really talented people who want to perform and they're high achievers and they want to get rewarded well, they go work in public accounting or private sector. So a lot of your top talent isn't going to go work at the IRS. So then you've got the top talent outside the IRS, and it's this like cat and mouse game, right? The IRS is like creating rules, and then the private sector figures out how to game the rules, right? And I think there's an education gap. So one of the things that I learned in really just studying this and researching this is when you go to the largest, like highest levels in the country. So think your big four public accounting and your like Fortune 500 companies, and you'll see it make an article. Oh, this top company didn't pay tax. or whatever. And everybody's, oh, it's terrible, right? They paid lots of taxes. They probably paid real estate taxes. They paid payroll taxes. They're paying property taxes. They're paying franchise taxes. They're probably paying all kinds of taxes, right? Yeah. Maybe they just, in one category, got away with little to no tax. But what exists at that level is massive amounts of effort and talent being proactively deployed to create that outcome.
Yes.
And so I grew up in small town USA entrepreneur family. We didn't have big four firms engaged, putting massive amounts of effort into planning for our family, right? So we had the person next door or whatever helping us. And so there's this gap, like sophistication gap. So you go, okay, well, where do the people at all the Ivy League schools tend to go? Like my friends from Harvard, they want to go to the big four, right? Or whatever. They want to go to big name firms. They want to work on big name companies. One of my friends, he kind of makes fun of my work, and he's like, how's Big Fan Dan doing? Like Concrete Roger, and he makes up all these nicknames for, because he's over there working on some household name company, right? So there's not like this like glory factor or whatever. And what you find out though is that the work at this, like, let's call it, your regular, successful, not household name, nobody really knows that you're making a lot of money entrepreneur, they're not tapping into those resources of the big four, the public companies that those companies just think of as like, they think of it no different than you writing off paper for your copy machine. They think of it no different than you writing off payroll as an expense. It is just, this is how you run an efficient business from tax standpoint.
Yeah.
Then you come down to like the entrepreneur, especially the self-made ones, like yourself, that you scratch, claw your way out of the mud and into something. And you're like, wow, okay, I'm making more money. I don't have the family background to tell me. I've got the advisors from when I was brand new. I'm not tapping into the highest levels. And then somebody comes along who has the education or the experience or the sophistication and says, hey, here's what big companies do. We can do a little bit of it. We can kind of do some simplified versions of it in your world. And you're like, whoa, that feels like a scary loophole. Why has nobody ever told me about this? This is brand new. And it's like, yeah, well, you're also brand new to making a lot of money, and the advisors you might have, maybe they work with people that don't make a lot of money. Maybe they don't have the sophistication or the education or the experience, right? And maybe the friends that you hang out with, we don't really talk about money in social circles, but maybe the ones you do, maybe they don't know. And so it feels like, I think of this analogy of like the flat earth deal, right?
Yeah.
And you're going, well, I've always been told the earth is flat. And somebody's like, no, man, you got to get on the boat with me, because if we go over there, there's a whole new world. You're like, no way, I don't want to fall off the end and die. And I think about that, like when we hear new things about finance, I'm sure you see it when you're educating people on investing, for example, and it's new. And it's kind of scary. You're like, how do I know I can trust it? How do I know it's real? How do I know it's not too good to be true? You're like, hey, look, this is what people with a high income or a lot of wealth, this is how they do it. But it's a little scary when it's new. And so, I think it's this like education process of going, okay, I need to learn, and I've got to like learn from people that have that experience in education. So
that's it, man. The education piece is a big deal. That's the biggest missing component, in my opinion. It's the reason the Way to Wealth was designed. We created, as you know, one-page tools for each one of these pieces of the process for an education component. So people have to know it all, but it gives you the ability to just synthesize it down where you're like, oh, I get it. These are incentives. These aren't loopholes. And oh, here's some things that I should be thinking about that wealthy families and others have been doing for years and years. And I might be able to integrate and implement this at my level. So that's the idea of the tools, which, by the way, as usual, we'll put a link in the podcast on some tax planning tools we use to simplify and make this piece simple so that you can wrap your arms around it and can get some traction to do something with it. One of the things, Jeff, so we're a little bit on the philosophical piece of tax planning, which is great. And then we're going to dig in to some details. I would say, I've heard you say this in the past, and I want you to just add a little bit of color to it. And that is the difference between, when you're thinking of taxes, the difference between strategy and compliance. And we've talked about that. I think it'd be useful to hear your thoughts on that.
Yeah. So compliance is what most people are worried about. Hey, if I'm not in compliance, I'm going to have a problem. Yes. If you're not in compliance, you're going to have a problem. It's just a matter of when the IRS catches up to it. But I hear that there's a lot of additional funding coming for the IRS. So they might be staffing up to come find it. So if you've been getting away with being non-compliant, well, its party might be coming to an end. But so, when you think about preparing and filing tax returns, like let's just make it real simple. The IRS and the tax code, for the most part, is now we got to separate it. Let's talk about in context for self-employed or entrepreneurs, people who are generating their own income, independent contractors, maybe, but generally, let's just keep it in context of that. Like you're self-employed, you own your own business. Your taxes are essentially based on the honor system. So the IRS says, "Hey, Scott, you have a business. We really don't know what the heck's going on in your business. So once a year, this is what I want you to do. Will you send me some forms? I want you to do it on my forms. I'm the IRS. Okay. I want you to do it on my forms so it's consistent. So my staff, they can all read it, the same form. And I want you to tell me how much money came into your business, how much you spent, how much is left over. And then I want you to run it through this grid and calculate how much you owe me. And then I want to make sure that you send me that money. Okay. And then what we're going to do going forward is say, let's just divide that by 4. Let's assume that you're going to be as good next year as you were last year. And so I want you to take that number, divide it by 4, and send me that quarter every quarter. Right. And we'll call those estimated taxes, and we'll true it up at the end. Okay. Sound good? So like you'll tell me the right numbers. Right. And here's what I'm going to do. I'm going to kind of create this lottery system. I can't spot check everybody. So maybe in the low single digit percentages, we're going to just kind of draw names. And if I draw your name, I'm going to come double check. I trust you're telling me, but if I draw your name, I'm going to come verify that what you told me is actually real. We're going to call that an audit. Okay. And if what you told me is what was real, well then great. Thanks for letting us do the spot check. And if it's not, well, then we're going to settle up and go, hey, I think we've got some discrepancies and you owe me a little bit more money than you paid. So time to pay up. Okay. We'll call that an audit. And that's what compliance is. And so what we're in the habit of when we think of taxes is we go to a CPA, we give them our stuff. Usually it's not very organized. They take all the stuff, they put it in all the compliance forms, ship it off to the IRS, along with us writing a check and saying, here's the money that they calculated for us to keep us compliant. And that's what we think of generally as a country for taxes. And when you're an entrepreneur, it's literally on the honor system because you're just turning in your books and you're saying, this is what came in and this is what went out and here's what was left and I'll pay you tax on that. And occasionally, maybe you go your entire life without getting a spot check, but maybe you do. Okay. So that's compliance and you have to do it. You need to do it. You shouldn't try to cut corners there.
And by the way, just to interject one thing, even if someone's retired, pre-retired and working for someone, so they're not an entrepreneur, they still have a similar compliance methodology. They're taking their stuff to a CPA firm, et cetera, right?
Yep. And it's a little less on the honor system.
Right.
The government doesn't trust employees as much. And so what they do is they say, okay, hey, Mr. Business Owner, I want you to send us a little side copy of what the employee got. And then the employee, hey, we want you to tell us what you got. And we're going to have a little checks and balance and make sure that you're telling us you got what the employer told us you got. So they call it a W-2 and a W-3, and those need to match, right?
Yep.
But for entrepreneurs, hey, just tell us what came in and what went out, right? Yep. So all strategy is back to planning, is going, hey, instead of showing up in the spring, or if you extend in the fall with your CPA and saying, I don't like the outcome, what can we do about it? Well, I don't know about you. There's not a whole lot I can change about yesterday. If I didn't eat well, it's kind of hard to change that. If I didn't, take care of my business, it's hard to go back and change that. There's not much I can really change about yesterday. So what I can do is decide today to change going forward. So when you go to them after the end of the year and you say, I don't like the outcome, it's really hard to go back to a prior year unless there was just a mistake, an oversight, but unless there's something missed, it's really hard to go back in the past and go back and change last year. So you think, what are CPAs generally working on? It's 2021 right now. CPAs are working on 2020. They're always working on last year. So when we think about strategy, we got to think about current year. Hey, we have 6 months left in this year, not even. To say in 9 months or 12 months, when we talk to the CPA about our compliance, it's not their fault if the outcome isn't if we don't like the outcome. It's our fault. We've got to take ownership right now and say, I'm going to decide during the calendar year to change what happens in my financial life so that when they report it for compliance, the outcome is more in line with what I'm looking for. So I have to make decisions right now so that next year, when we're looking backwards to do compliance, that it turns out more in line with what I wanted.
Yes, that's a great analogy and example. Yes, since I know we talked about it, I just thought it'd be useful for the audience to hear it and have the same thought process and agree with that. Is there's in just the difference even of advisors that some are more compliant, some are more strategist, and just to make sure that you have both on your team.
Right.
That's part of who's working with you to give you that type of advice, and you need both.
Yeah,
it's important, and it's great
to have both. Well, I guess the problem is you don't actually have to have both. You have to have the compliance piece. So most people have that, which is looking backwards.
Yep.
But what most people complain about is that the person they hired to look backwards is not looking forward. And so then you're complaining about, hey, I've got this advisor whose job is to look backwards and report what happened yesterday. And I'm so frustrated that they won't talk to me about how to change tomorrow. You're like, why are you frustrated with that? Like you hired them to make sure they're reporting on what happened yesterday and then it's compliant. And you're frustrated they're not telling you about how to change tomorrow.
It's right. A better way to say it would be you should have both. Ideally, you would have both.
If you want an optimal outcome.
Yes, exactly.
You'll hire somebody to talk to you about what's going to happen tomorrow and how to make it more about the way you want it.
Totally. So on that note, Jeff, so what's an example of, and you're given some, but what's an example of tax strategy or planning done poorly?
Well, I think the poorly done tax planning is just not doing tax planning. And that's where I think most people are. So if you're willing to invest a little bit of time and resource into proactively managing one of your largest expenses, then you're going in the right direction. I think one of the challenges that people have is in the education and kind of sophistication gap. So there's a lot of myths and misunderstanding. So probably the most common one that I hear of is the home office deduction, right? You may not think it, but the irs.gov website is pretty good. So go there, type in the search bar, home office deduction. I think there's a few different ways they give you to calculate it. So just think about it. Like if you go to the irs.gov website, you type it in, they give you a few different ways of calculating it, and you're not going to do it. Like help me understand that. They're literally telling you, yes, we're giving you this incentive. Here's a few different ways you can take advantage of it. Figure out which one is best for you. We don't care. You can do any one of these methods. But why would somebody not do it?
In that example, Jeff, is the myth there that you cannot do it? Is that what you were saying is the myth that people say you can't do a home office deduction?
or that it's a red flag. This
Okay.
thing about red flags. I'm like, have you ever talked to anybody from the IRS that's like, oh, we have a red flag software program, and even though we gave you 3 different ways to calculate your home office deduction, if you actually do it, it's flagged in our red flag software.
That's good. So that's a good example, right? That's helpful. So what happens then, even if someone's not a business owner, entrepreneur now, they could start some sort of a side hustle, whatever you want to call it. We're doing something and be able to benefit from something like this.
Yeah. And so let's talk about like what's like the most likely worst case scenario. You write off your home office and you got, I don't know, $5,000 benefit. Okay. And the IRS draws your number and you get the audit. And they come through and they say, hey, Scott, you don't have a home. You don't have a home office. You have nothing that qualifies. You get none of this. What's the worst thing that can happen? Yeah, they're not hauling you off to IRS jail. They're going to be like, hey, you know that $5,000? Yeah, you owe it to us. So pay up. And you write the check. Okay. I mean, I'm more of the mindset that I would rather take the position to keep as much of my money as possible and have them have to tell me that I owe them more. And if there's a dollar that's going to go one way or the other, I'd rather be the one keeping the dollar and have them have to get it from me than just give them extra, hoping they don't ever ask.
Yeah. What about penalties there would be someone would certainly ask.
Yeah. I mean, okay. So like, have you looked up the interest rate or penalties? It's pretty minimal. I mean, and I think it's something like 4% of S Corps ever get audited. So like if you had an S Corp and you have a 96% chance of nobody even asking you about it, and like, that's pretty good odds. And I mean, and what's the likelihood? The likelihood is not that they say you get 0 home office. They're going to say, oh, you got $5,000 of benefit and we think you should only have $4,000 of benefits. You owe us $1,000 plus some interest. So it's $1,050. Oh, yeah. Okay. I mean, great. I don't,
Yeah. What would be, so that's some examples of tax planning done poorly, i.e. they're not planning is the biggest. And then there's you gave some good examples, or a good example of common myth or misconception out there of red flags as an example. What would be an example or so of tax strategy planning done well from your experience that you've seen?
So I like to think about it as kind of like, what is the really easy, straightforward, simple stuff? And are you maximizing all those things? So are you maximizing all the deductions that they give us that are really straightforward? Use of your home. You talked about you and I both being employed as children. If you have a business, are you putting your kids on payroll? Are you teaching them work ethic? In your case, it sounds like there wasn't much write-off because you got paid a Pepsi. I got at least paid something. So there was some write-off there for putting me on payroll. But, there's things like that. There's like accounting driven stuff. Okay. In 2018, we had a massive change of the tax law. Are you looking at things like your wages and business deductions and optimizing all those calculations that have to be done during the calendar year? There's a ton of incentives around retirement, qualified planning, investing, savings for that. Are you doing those things? Are you like taking all the low hanging fruit that's out there? Right. So there's all sorts of qualified plans, home deductions, things with your family, managing your payroll, efficiency there. I mean, like, make sure you're doing all the low hanging, like accounting driven, just straightforward. This is not adding a lot of complexity or strategy to your life. This is just like, we're doing all the down the fairway, simple, straightforward stuff. Mm-hmm. And then once you've got all that maximized, then go into considering what you might want to be able to do on top of. And what we were talking about earlier about mastery of money through charity and philanthropy and generosity. If you get into that mindset and you do have high income, boy, the government, I tell you what, I mean, and it makes sense. They they open up massive tax efficiency if you're willing to be philanthropic and charitable. And think about it. The government has this notion about like, okay, if there's people in society that aren't taken care of, somehow they end up as a burden on the state. And so if you and I are willing to be generous and help take care of our communities, right? The government's like, please do that so we don't have to do as much of it.
Yeah.
Right? We will throw massive incentives at you and they'll increase the incentives. There's all kinds of stuff you can do. So, I mean, you want to get super tax efficient, then get super generous, right?
Yeah.
And that will open up a whole new world of tax efficiency to you. There's just countless things you can do there.
We're thinking in this case also about retiree. They have 500,000 to 2 million invested. What are some things that they could be thinking about? So you mentioned qualified plans. If they're still working, that's a potential option. If they're not, well, there's still some tax planning options there. Maybe it's a backdoor Roth they could look into. What are some other things that might come to mind with someone in that category?
Yeah, and there's financial planning software to model all of that, but you've got to take a look at your assets and look at being proactive with, when you're talking about people with investment accounts. I mean, look at things like tax loss harvesting. If you're if you're retired, then you're probably getting Social Security. So you're fortunate enough to get it, while it lasts. But so there's different tax breaks in Social Security. So like, are you paying attention to the taxable income thresholds in Social Security? And are you thinking about, with the way tax code works and being calendar years, you can start to like chunk things. You could maybe take some income out throughout the year, and then maybe I'll load up in December for next year if I know I'm going to blow maybe my Social Security thresholds. And then I'll just kind of spike my income, but I'll pay attention to tax brackets so I can manage my tax brackets, pull what I need. And then maybe next year it'll be like my lean year where I don't really have to pull anything. I can have like, okay, I realize I'm going to have to pay some taxes this year. So let's optimize brackets. And then next year pay like almost no taxes. Right. And I can start to manage that just by, thinking ahead, planning, being proactive, looking at my tax brackets, looking at like Social Security brackets, looking at, strategic, what do I sell? Which investments am I using to provide income? And then you can model things like, hey, if I convert to a Roth, like how much should I do? You're looking at all those same thresholds and what is the long-term impact of that? And, there's all sorts of stuff you can consider there.
Yeah, no, that's helpful. So some of those examples would be like, bracket bumping in various ways to look at how do we optimize or be efficient with this type planning.
Yeah.
What about, if you start getting into the 2 million to 10 million, and then certainly the 10 million on up of investable assets and or net worth, then you can get into some additional planning when you start thinking of taxes. What comes to mind there? And really the big one I think you mentioned, which is charity. I mean, I think that's a great phrase you had mentioned. If you want to get super efficient with your taxes, then get super generous. I thought that's a good comment. What else comes to mind?
And so like, as taxes are mostly driven by income, not by net worth or assets. So if you hold investments, you're not paying taxes on them for holding them. You pay taxes when you sell and you have the gain. So you can look at, well, can I sell enough to stay in the 15% versus going to 20? You can look at if your net worth starts getting over 20, you're going to start considering estate taxes as a tax planning topic. But when you're just talking about the investable assets, if you're not earning a high income, then you can really manage, by selling things that are down, tax loss harvesting, looking at if you have real estate, doing 1031 exchanges, or if you need to cash in on big gains, maybe you have opportunity zones that were created in the last round of taxes. But being charitable, instead of giving cash, like think about giving appreciated stock, give away the appreciated stock, they can sell it, the charity can, and not pay tax on the gain and you get the full write-off. So you kind of get a double bonus there on tax planning versus giving cash. So, and then thinking about, again, like chunking things together. But, when realize also that taxes are driven mostly by income, and you have it when you're, if you have $10 million of assets, investable assets, and you're living on it, or you're kind of winding down your active income, you literally have full control over your income.
Yeah.
So you basically have full control over the taxes you pay.
Yeah.
And I think it's important to note this. In tax planning, the amount of money you need to spend and consume is pretty much the amount of money that there's not hardly any way around paying taxes on.
Yep.
So you also have control over your lifestyle. And so the bigger your lifestyle, more likely the bigger your tax bill. That's not really controllable. But beyond that, beyond the lifestyle needs, you can get very tax efficient. I mean, back to the charitable planning world, if you said, hey, I just need this much, I could put all the rest of my assets in a charitable structure, a trust or entity or whatever. Yeah. I can buy and sell and do all sorts of things to really expand that in a very tax efficient way. Yeah. And then I just pay taxes on what I'm actually consuming.
Yeah, no, that's a great point. And I know we've talked about that, and to that very point, like what is the lifestyle expense? What can you do there? Well, the only thing I'd add to that, totally right. The only thing I would add to it is the earlier you start preparing for that number, you can be more prepared at that time. Meaning, let's just say the number's 100,000 for easy math. Well, if you're there today, to your point, and you're all in a tax qualified account, and you have some cash, well, guess what? It is what it is. You're going to take the distribution. It's 100,000, it's going to all be taxable. However, if it's 10 years before you get there, and we can start saying, maybe taxes are on sale now, and maybe instead of having everything in the tax postponed / tax deferred place, maybe we should have more taxable, and better yet, maybe we should have some more tax free. Now, all of a sudden, we can start playing with various brackets and the various exemptions to say, hey, we could take up to X amount this year based on your exemption, take that from the qualified plan, supplement with cash, take the rest from tax free. Now, all of a sudden, we're pretty efficient, but you got to start that before you get to needing that actual number. So yeah, totally agree with everything you said. Just wanted to add that is the more proactive we are in planning, these are some of the benefits that we can receive by being proactive instead of just kind of going through life sometimes unconsciously.
Being proactive is like step one.
Yeah.
So, I mean, and it's like, hey, the government might create dramatic changes for the tax code. So if they do, what are you going to do about it?
Yeah.
Right. Are you going to be proactive? Because like you said, you might find that taxes are on sale this year compared to next year. And we need to cash in all of our gains and pay a lot of taxes very intentionally to increase our basis so that we have less tax going forward.
Yes.
We might have to do that. You go, what do you mean paying more taxes as part of tax planning? Well, if you're proactive and you map it out, you go, oh, this makes a lot of sense.
Absolutely.
So
exactly.
You got to be on top of that. You got to be proactive. You got to be thinking about it, right?
Yeah, I think that's the big message. That's what I would want listeners to be really thinking about is, are you being proactive, or are you being reactive in your tax planning, or are you even doing it? So two final thoughts or questions, and just one would be, listeners probably have a relationship with, a CPA or someone who's helping them with taxes. What questions should they be thinking about asking their current tax advisor if you were in their shoes as a listener? What questions would you suggest they consider asking?
I think a great question would be to just have an open conversation about, hey, thank you for the great compliance work that you do. Do you have a part of your practice where you do proactive planning looking ahead? And if not, would you recommend that I go talk to? Like, and then you make it really easy for them to help you get the proactive advice without feeling like they're to blame for not being proactive.
Yeah.
You give them permission to be the compliance person without having to ignore this proactive need.
Yeah, that's a great question. There's no judgment in that. That's like they're
Right.
doing their role, and then you position it that way. Maybe they can and have someone on the team. Maybe they can. Lastly, as we look to wrap, Jeff, what would, if someone wants further information from you, again, we're going to have links here below as far as things that you could consider if you're, let's say, 500,000 to 2 million, 2 million to 10 million, 10 million up of investable assets. Some potential strategies that you could consider with your current advisor. But if someone's like, hey, I want to learn more about this, Jeff and what he does and wanted additional information, what's the easiest way for them to access that?
Well, of course, they can just reach out to you and you can loop me in where it's appropriate. If people want to follow me, I have a website, jeffsocha.com, that you can keep up with me or follow me on social media and send me your questions, send me your thoughts, send me your ideas. You can find me there, or you can always reach me through Scott.
Fantastic. I've appreciated you've been very generous with the time and has always dropped some solid knowledge for us. So thanks for that, Jeff. We'll probably have you on again as well in the future with additional commentary. And that's it, folks. Thanks for joining us. Again, The Way to Wealth, it's all about making money simple so you can focus on living life now and do that fully. See you all on the next episode.
The opinions voiced in Way to Wealth with Scott Ford, Managing Director, Partner, and Wealth Advisor of Carson Wealth, are for general information only and are not intended to provide specific advice or recommendations for any individual. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Guests on Way to Wealth are not affiliated with CWM LLC or Socha Advisor Networks LLC. Carson Wealth, 19833 Leitersburg Pike, Suite 1, Hagerstown, Maryland, 21742.